I am here with Ben Garland, one of our newest investors, and he's here to ask some questions.
I'm Ben Garland. I had an 11-year career in the NFL, and now, like you said, I'm an investor. Darwin said that he believes in full transparency, and one of the best ways to do that is through education, so I'm here to ask him some questions. One of the things I want to know is taxes. I hear the ultra high net wealth individuals really understand and take advantage of it. Within real estate, are there areas that give me a tax advantage?
Unbelievable tax advantages. And of course, you've got to think, who writes the laws? These are all rich people that write the laws, and they all invest in real estate, so there's a lot of real estate benefits written into all the tax code. For example, a big one is depreciation, and it's a non-tax deduction that basically what it does is it lowers the amount of tax due that you have on your cash flow. If done right, your cash flow is tax-free. So if you're getting an 8% return, actually, let's say a 9% return, just because it's easy on math. 9% return and you're in a 30% tax bracket, that's like earning 12% because of that depreciation write-off. Now, you do have recapture at the end, but that's pushed off till the end, and there's other strategies you can use after that.
That seems like a huge benefit just from that alone. What's a real world situation of how do I really take advantage of this? Does it work against my normal income? How do I actually get this depreciation to work for me?
Okay, well, now you're getting into complex tax situations, and I got to make sure that I put in the disclaimer. I'm not a CPA, I'm not a lawyer. There is the thing called a 1031 exchange, tax deferred exchange. So in my history, we've done those, and that's how we ended up in Texas. But a 1031 tax deferred exchange allows you to sell one property at a profit and go buy another property and not pay any tax on that gain. However, I mean, you're smiling, but unfortunately, we don't do 1031 exchanges. And the reason for that is you need to have the whole partnership stay together and agree to sell that property and go buy another property that they don't know what they're going to buy. And we like that the investors know what they're investing in. It's not some blind pool or something like that. So 1031 exchange doesn't work. However, the tax laws, especially how they've been in the past, there's something that happens similarly, and that's called bonus depreciation. We use accelerated and bonus depreciation, and it acts kind of like a 1031 if you reinvest. So you go ahead and you invest $100,000, okay? We hold it for 5 years, you have back $200,000. Well, that $100,000 gain would be taxed. Well, if you take that $200,000, reinvest it in another one of our properties, another one of our investments, you get bonus depreciation that's accelerated. So you take the first 5 years, and that makes that $200,000 tax-free. But wait, there's more. We usually try and have a refinance opportunity in there. And when you refinance, that's money coming back to you that's not taxed at all, because it's your money, it's your equity that you're getting back, so they don't tax that at all.
Wow, so you not only get the advantage of depreciating the asset, but you also get that secondary advantage of the possible refinance.
Yep, absolutely.
So what do you think? I mean, obviously the interest rates are terrifying right now. They keep going up, they're going up and up. That is an exciting aspect. Can you explain more how that refinance works and getting back that money? Do I still own part of the property when you refinance and give me back my money, or is that you're kind of done with me at that point as an investor?
Well, you asked two separate questions there, by the way. But the refinance dollars, when you get that back, your position is not diluted. If you own 10% of the property, you still own 10% of the property. It doesn't change, even though you've got all your money back. There's some instances where we've given over 100% return, 100% of their cash back in 14 months. So that allowed somebody to do that. They still have their carried interest in that property and got to reinvest in another one and another one and another one. So that's a way that we keep doubling and tripling people's net worth, is because they reinvest in the next one, the next one, the next one.
So I can take all of my money out while still getting the cash flow from that property and then get depreciation from another property?
Yes, but I'm going to go ahead and be clear on something. You can't take it out. Okay, that's up to us as the sponsor in our planning. We make the decision on when that happens, if it happens. But we judge the market to decide what's good and what's bad. Right now, the interest rates are so high that if we have a 3% loan on a property, we're not going to refinance that to a 5% loan, That would just be shooting ourselves in the foot. So we'll wait for this to all come out in the end. And there's studies. There's a great company called Pensford, and he's got a podcast called The Rate Guy. And they track interest rates and what's going to happen. And interest rates, once they start going up, like they have, it goes between 14 months and 27 months before it starts coming down. So we'll ride through that. If they start coming down, then there might be a refinance opportunity. We do a lot of agency debt, Fannie Mae, Freddie Mac loans. There's a lot of benefits to those we can talk about later. But when you refinance those, you're not refinancing the whole amount of the loan. You're getting a supplemental, a second loan. So you keep your low interest loan in place, and then you get a supplemental on top of that. So we might have a 3% loan on this. Rather than refinancing the whole amount, all we do is do a supplemental loan and add on to that. And that supplemental loan will be at a higher interest rate, but we still keep our original good loan.
So you get two different loans at different interest rates. So still take advantage of your old one while at the same time taking money out for your investors.
Yes, if the economics work out.
So is it based on if the equity of the property goes up? Because I know you talked about adding a lot of value to the property. Does that have to do with that?
It absolutely does. You need to increase the value of the property to allow yourself to refinance or do a supplemental to get cash out. But we also want to make sure that we don't put the property in a bad position. So we want to make sure that whatever we do, we're not shooting ourselves in the foot long term, because you can over leverage something. Banks usually don't let you, but if you get in a position where you're taking too much debt out, that adds too much risk to the risk profile of that investment. And our number one goal is always to protect the investors. So we will never do anything to put you in a position where we have a big risk.
Well, I appreciate that, since I'm putting money with you.
Exactly.
Protect my capital.
Exactly.
And whenever I get a mortgage, I can kind of take that off my taxes, the interest of the loan. Does that work the same way as an investor? Do I get to take the interest off my taxes that you're taking out on loans?
Okay. First and foremost, when you invest, you're investing your pro rata share in an LLC that owns that property. Okay, so it's just like buying a business or investing in a business. So at the end of the year, you get a K1, which is all the income and expense and everything for that property. That's what you're using to give to your accountant on that. So all of any tax benefits and everything is already calculated in your K1 that gets passed through to go to your taxes. So all that is included on the property level and will all show up on your K1.
That's awesome. So you do most of that work for me so that
all
my
of it.
CPA can deal with that in the back end.
All of it, you're going to get one form, your K1, that says here's your income and expense, and they put that and roll that into your taxes.
With that aspect, what can I actually use from the investment to work against my other income to offset that?
Okay, I'm going to say it again. I'm not a CPA,
Right.
so here's the little thing: you got to verify everything that I'm saying. But basically, you can take active losses against active gains, passive losses against passive gains. So, if you made money on a property, you could write that off against another property. Now, your main career is not real estate. My main career is real estate. So for me, all of that is an active gain and an active loss. For you, it's a passive gain or a passive loss that would go against other passive income or loss. So if you had some other investment that was a passive investment that made or lost, those would net out together. There is a huge benefit to becoming a real estate professional, which talk to your CPA about that, because then it's all active, and everything you do is active gains and active losses. There's a huge benefit to that.
So I can use the depreciation from the asset to offset my passive income, unless I'm a real estate professional, and then I can use that to offset my active income, is what you're saying.
That is correct. Yeah.
That's awesome. That's a huge advantage. There's all these investment vehicles that are, get your Roths, your IRA accounts. What do you think is the best investment vehicle for tax advantages?
Me personally, I put everything in real estate. It's a solid investment, a long-term gains, long-term protection, tax benefits, appreciation, depreciation, leverage, everything goes into that. So I put, for me, everything in real estate. But that's who I am. I'm a real estate guy. I can't advise you on anything else or tell you anything about it. I'm not knowledgeable enough in those other areas. I will say that IRA, 401k, we have a lot of people that use self-directed IRAs. So if you have an IRA, you can convert it to a self-directed, and all that means is you tell your custodian where you want to invest it. So we have a lot of investors that invest through their IRAs, their self-directed IRAs. And we also have an opportunity, which I think you've started taking advantage of, is we've got a tax strategist as part of our team, a guy named Charlie Dombeck. It's 10 grand just to sit down with this guy because he's so good. Saved me about $1 million in taxes last year. But he can sit down with you and actually line out different strategies. For one of our partners, he freed up $2 million that he had stuck. He was a pilot, and it was stuck in their retirement account. But he showed him strategies of how to get it out of that so that he had free cash to invest rather than having it tied up in the stock for the company that he worked for.
That's huge. I've really enjoyed my time with Charlie, and I'm really excited about what he can do for me. You definitely get what you pay for, and he's been worth every penny as far as what I've done. What I'm also excited about is there's other areas where you can get tax credits. Is there anything within real estate, or I've heard of opportunity zones? What is that?
Well, an opportunity zone is basically an area, if you invest in that area, and again, there's a lot of regulations that go into what it is, but in general, you invest in that property, you put money in there, you improve it, and you hold it for 10 years and you sell it, there's no tax on the gains. So that's a big benefit. However, opportunity zones are opportunity zones for a reason. They're at the lower end of the barrel as far as good opportunity, good places to invest. So you don't invest in that just because it's an opportunity zone. It still has to make sense as an investment. So again, rule one, it's got to make sense as an investment in that area, et cetera. The opportunity zone would just be icing on the cake.
That sounds like a great opportunity. I know Texas is considered great for taxes. Do you think that gives you any advantages as far as investing in Texas?
Oh, absolutely. Back in the early 90s, my dad moved from California to Texas as his primary residence, moved out here, moved everything out here, mom, everything. The tax savings from California to Texas paid for his house and 2 cars. My brother, I better verify that I can say this, by the way. My brother, he paid $50,000 in federal income tax. He lives in California. $50,000 in federal income tax, $200,000 in state income tax. And that's just ridiculous. They're high tax states, and that's why people move out of those states and move to places like Texas and Florida and Tennessee, where you're not going to get taxed on your income.
I know that's true. I mean, I finished my career in California, and it was rough seeing what they were taking out in taxes. So I definitely loved California, living there, but did not love what I saw taken out of my paycheck every week.
They call that the sunshine tax.
I really appreciate your time today. I'm really excited about the advantages of investing in real estate to really help my CPA's job, because I know getting a couple of this depreciation, some of the other passive income I'm receiving is really going to help my personal wealth. And I know you've been helping a lot of people along the way as well.
Absolutely. Just as another sidebar, I'll talk about my brother real quick. He's been doing on his own. I'm a syndicator. I use other people's money and match it with our experience to go out and buy properties. And that way we can buy more and bigger deals. My brother does it exactly opposite. He just buys his own properties, and he does 1031 exchanges, so tax-deferred exchanges. And he took $20,000 over 20 years, did 20 deals, and turned it into a $20 million portfolio. The problem with the 1031 exchange is your basis remains the same as the first property. So his first property, it maybe he bought for $100,000. Well, over time, he buys a $10 million property. His basis that he's writing off on taxes is only that $100,000. He now has no basis, and you're taxed on the gain above your basis. So his is all gain. He can never sell that and just take the cash out, because it was all gain. It'll all be taxed, and I'll be taxed in California at that.
Wow, so he made massive gains, but in the end, he has to keep doing 1031 exchanges until he dies. Otherwise, he can never take full advantage of the growth he saw in his portfolio.
Yeah, and now he needs to get real sophisticated with tax planning and tax strategies to shelter that. But it can be done, but it's very difficult. It's very easy the way we do it, because everything flows through on your K1, and you just give that over to your CPA and you don't have to worry about it.
What do you recommend as far as tax planning? It sounds like he's got a lot of stuff he has to deal with, but I think a lot of people that are in the investor category have some pretty complicated taxes. Is there any one or anything you'd recommend?
There's a certain liability to recommending one person, and I don't take that liability, and everybody has a different what they like about their CPA. I want a CPA that's going to be conservative but also get maximum deductions for me. And by nature, CPAs are very, very conservative. And so you want to make sure you have one that's still trying to be a little aggressive and take advantage of all the opportunities. And so talk with them. Again, it would be great to talk to somebody, a tax strategist, that can help you come up with the plans, especially as your income grows. You want those other strategies. If you ever look at that if you bought something, you paid the taxes on it and reinvested it, made money, paid the taxes on it, the growth is exponential when you take those taxes out of there. It's just huge, and it's very important to try and have any tax shelters.
Yeah, I mean, they talk about even small gains over time, how impactful that is.
It's huge.
I imagine adding, not only did you get your normal gains, but you're not paying taxes on those gains. It seems like it really could accelerate your portfolio.
Oh, absolutely, absolutely, definitely.
Awesome. Thanks so much for your time. I'm really excited about this, and it sounds like real estate really is like an ideal investment.
Absolutely, and I'm glad you plugged the ideal. Thank you so much.